Good morning, everyone. Thank you, Andrew. Thank you, Marine Money, for inviting me to speak today. It's always great to be here in Singapore. So, as Andrew said, the title of my presentation today is Crosscurrents and Choppy Waters, Navigating Towards a Safe Haven. And over the next 20 minutes or so, what I hope to do is just give you an insight to how at MSI we're seeing the markets develop and how we expect them to go on here on in for the next few years. Though the clicker isn't working. Yeah, that's me. Okay, there we go. Okay, so what I thought I'd do was just start off by just taking a very sort of top-down look at where we are within the shipping markets before we drill into what's going on in the underlying fundamentals. Does this clicker work, or because there's a lot of slides, that's gone one too many now. I need to go back a slide. Okay. Yeah, I wouldn't want to slide back now. Okay, so as I said, what I'm going to do is talk about some of the headlines and do a top-down approach, but I think it's important to say that there are a lot of headlines in shipping at the minute. Over the course of the last 18 months or so, headlines have come thick and fast. Some of those are changing the markets in the short term, others in the medium term, and of course we've also seen some that we think will change the headlines and the market fundamentals for some time to come. Next slide, please. But where have the shipping markets themselves gone over the last 12 months since I was last stood here in Singapore presenting at Marine Money? So just to give you a flavour for where they've been over the course of the last 12 months, this is the movements in the one-year TC rate and the movement in asset prices over the course of the last 12 months. And I think the overriding feature of this slide is there's a lot of red on the charts. That means that we've seen a softening in both asset values, we've seen a softening in the one-year TC rate. Now, of course, the sector that has stood out and continues to stand out is the container ship market, which continues to go from strength to strength. Where does all of this mean we are on the infamous earnings cycles slide? Well, basically, as we can see, there are a lot of sort of core shipping sectors on the left-hand side of the chart, or the infographic. And what this means is that we've seen a softening in the fundamentals, and hence we've seen that lowering of the one-year TC rate over the last 12 months. We've got LNG, which has passed the bottom of the market cycle. We saw record lows in the first half of 2025 for some asset classes in the LNG sector. That's past the bottom, but we don't expect it to rise particularly fast over the course of the next 12 to 18 months. And at the top of the market cycle, we have still some sectors of offshore, which are bouncing around at the top of the market cycle. And as I say, we have containers, which continue to improve almost week on week, even though that some of those incremental upward lifts aren't as big as they once were. What all of those earnings mean from a profitability perspective is what I've done here is just done the break-even level, that is debt service from the banks, and the daily operating costs, that's the stacked bar. And the red horizontal lines show you the one-year TC rate. So obviously where we've got a gap between the stacked bar and the one-year TC rate, that means that you've got cash in the system on those individual assets to pay shareholders, to pay equity, and to potentially reinvest. I guess the two sectors that stand out are LNG, which I've already mentioned, have just come off the bottom of a market cycle, and dry bulk. The red lines, the horizontal lines on dry bulk, you'll see are sort of pretty much on top of the break-even levels. That suggests that, we need to see some rebalancing. Either we need to see increasing earnings, or we need to see a decrease in asset values to really make those vessels sort of sustainably profitable in the medium to longer term. So moving now on to the cargo developments, I think it's important to say, and this is just a 50-year snapshot of cargo growth, that we're in a lower cargo growth environment today versus where we were 15 or 20 years ago. Back then, you could rely on 4-5% year-on-year cargo growth in aggregate across shipping. Now we're in the sort of 1 to 2% cargo growth territory. Still growth, but not as we used to know it. And of course, that has implications when we start talking about on the supply growth, where we're going to always see a lot more than 1 to 2% supply growth, as we'll see as we move forward onto that part of the presentation. But if we boil things down and we try and look at things on a sort of a bit of a shorter time frame, we look at things on a more of an asset class basis, we can see that actually, in general, we're going to see positive cargo growth for the majority of sectors. You will notice some blips where we are expecting to see negative cargo growth, primarily car carriers for 1 year, products and crude tankers for 1 year. But it is just a single year. I've also put on this chart the 10-year average cargo growth. We can see that for the gas sectors, the next few years we expect to see strong cargo growth if we compare it to the historical averages. If we look at things like dry bulk, if we look at things like chemical tankers, we're expecting to see a lower growth environment over the next 2 or 3 years versus the longer term average. Now, if we sort of do a bit of a deeper dive into the main tanker bulk container sectors. This is on the container side. What we have here is main lane trades and the non-main lane trades. And I think what you can clearly see is the impact COVID had, both the increase in trade and then the sort of the consequences of that increase once stocks have been built, once those stocks were being run down. But what I'd like you to do is just focus more on what's happened in the last sort of 6 to 8 months. We can see on the main lane trade, there's definitely a downward trend in trade growth, whereas on the non-main lanes, we can see that we're seeing an upward trend in trade growth. So we're getting different signals coming out of where we're looking on the main lanes or the non-main lane trades at the moment. And of course, one of the reasons that we're seeing this disconnect between the main lane and the non-main lanes relates to tariffs. And from Jonathan earlier today, we heard a lot more about the tariffs and the impact that was having on aggregate trade. What we've done here is boiled up what that actually means for container ship trade. And we can see on the chart on the left just how low Chinese volumes into the US have dropped over the course of this year. And of course, a lot of that is going to be generated by the tariff position. We can see on the flip side, the ASEAN nations have picked up some of these lost volumes, and we can see some strong growth here. And then on average, if we look at the hatched red line, we can see that on average, trade from from Asia to the US has sort of remained at around 0 or just below 0. Looking at aggregated trade and the growth of incremental container ship trade as we go forward, we can see that perhaps next year some of the tariffs will further have an impact in trade growth, and trade growth will sort of drop to around 2%. But after that, we expect things to pick up and sort of container trade to remain at around 4%. If we move now on to the dry bulk markets, the dry bulk markets last year benefited not necessarily through consumption of commodities, but certainly a build-up in stockpiles. We can see the build-up in Chinese stockpiles on the left-hand side of the chart, and here we can see really for coal, we saw that go great guns during the course of 2024 and even into 2023. Also, iron ore, we saw a build-up in iron ore stocks in China last year. Now, that sort of stockpiling rationale has been driven by the government. We think that they've now reached the requirements that the government has set down, so we don't expect that to continue growing. And on the flip side, when it comes to coal, what we're seeing in China is this transition away from coal, thermal coal, as a source of energy. And as we can see on the chart on the right, which just shows you the Chinese energy consumption by fuel source, we can see that we've seen a gradual, and it has turned into quite an increasing decline in thermal coal as a source of energy in China, and that has been replaced by renewables. China is by head and shoulder the biggest driver in renewable energy consumption in the world by some mile. It's not all doom and gloom for dry bulk. There are some trades that have really shown some promise and some strength during this year. The top left-hand chart just shows bauxite exports from Guinea. We could see that during the first half of this year that we saw huge increases in bauxite exports, 37% above where they stood at this time last year. That's obviously been great. A lot of that has been going to China. So West Africa to China, quite a long trade, very good for the ton miles perspective. And in the bottom left-hand corner, we can also see that we've seen some very strong soya exports, predominantly from Brazil, heading to China, which has also helped with ton miles. Obviously, it's a trans-Pacific trade, and has also helped with the Panamax and the lower sizes of asset classes. And this is a theme that we can expect to continue as we sort of move forward, that the growth in dry bulk trade won't be driven necessarily by coal and by iron ore. It'll be driven by minor bulks, it'll be driven by grains, it'll be driven by bauxite, as we can see on the chart on the right. Moving on to the oil tanker market. Now, oil tanker demand, I think, is potentially a concern as we move forward, as we move towards the end of this decade. We can see on the chart on the right just how much of a spike we saw coming out of China in terms of oil consumption following the COVID lockdowns. And we can see that, you know, we always look for China wherever there's a growth story. We can see that actually China isn't really growing much in terms of oil consumption. Didn't last year, isn't this year, and we're not expecting to see much in the way of changes moving forward. The growth in oil consumption, you really have to be looking at places like the Middle East, you have to be looking at places like Africa to see actual consumption growth when it comes to oil. Now, on the other side of consumption, we have the production side, and of course, one of President Trump's rhetorics before he got into office this time was drill, baby, drill. Well, unfortunately, the numbers aren't suggesting that the US market is drill, baby, drilling. We can see on the chart on the top right, the US rig count, which, if anything, has sort of gone down since Trump has come to power. And of course, this has been due to the fact that the economics of drilling oil aren't stacking up in the US currently. Whereas if we look at OPEC, and OPEC, sometimes it places a sort of economic hat on OPEC, and sometimes it places a market share view on what goes on within OPEC. We can see that OPEC has actually started reducing some of the cutbacks that it put into place during 2022 and 2023 to try and keep the oil price relatively buoyant. Now it's going back to a market share strategy, and that is one of the reasons that we're seeing the spike in the spot market when it comes to the tankers at the minute, especially for VLCC and arbitrage. Pricing has opened up, and we're seeing a lot of VLCCs being employed shipping oil from the Middle East to places like China for stock building driven by pricing. So when it comes to the oil tanker market, what you really do need to do if you want to sort of try and play off the crude versus product is really understand where refineries are coming on stream. We can see on the top left-hand chart that realistically refineries are coming on stream in places like the Middle East, in places like South Asia, and also in Southeast Asia. We're seeing a retrenchment in refinery capacities in the Atlantic Basin. And it's interesting if you look at things in an aggregated form, as I have done on the chart on the bottom left. By the start of the next decade, we will see more refinery capacity east of the Suez than we will do west of the Suez. And this is the first time that we will have seen this dynamic. That will, of course, have implications for the crude market and the product tanker market. As the refineries move closer to the wellhead, then we need more products being shifted from the production to the consumption regions and less crude. And you can see that story panning out and playing out from the chart on the right-hand side, which shows you incremental demand for products and for crude. I thought I would give some sort of real positive demand side charts just to sort of whet everyone's appetite a little bit. You know, there are some positive stories out there. The first one is on LNG. We can see from an LNG market, we're going from around 400 million tonnes this year of LNGs being shipped. Even by the end of this decade, that's going to shift it up to 600 million tonnes. So a 50% increase in LNG on the water over a course of the next 5 years. So a remarkable increase in trade there. And if you ever did want a sort of a hockey stick type chart, then I think the offshore wind is probably the closest you're going to get in shipping markets currently. You can hardly see 2025, even on this very, very big chart. You can hardly see 2025 at the bottom on the chart on the right-hand side, but if you look at where 2050 is, it's a remarkable increase in offshore wind. And that's even with sort of the Trump regime sort of reining back on their anticipated offshore wind in the US. So moving on to vessel demand, and vessel demand is fundamentally where you do need to focus a lot of attention, and it's something that we spend a lot of time at MSI, translating that cargo into the number of ships you need to move that cargo. And of course, the sort of diversions around the Cape of Good Hope, away from the Red Sea, have been a huge driver for incremental vessel demand over the course of the last couple of years. This is just a snapshot from our new platform, MSI Seascape, which I just thought I'd put this up because it's a good visual representation of just how many ships are now sort of moving via the Cape of Good Hope rather than going through the Suez Canal. If we translate that into actual numbers, interestingly enough, the Panama Canal, people have sort of forgotten the Panama Canal a bit, but we can even see in the Panama Canal that the volumes of vessels going through the Panama Canal haven't returned to those that we saw pre-drought at the end of 2023, at the start of 2024. But obviously the most eye-catching chart on screen currently is what's going through the Suez Canal, a huge drop-off. Some ships are still going through the canal, as the stats show, but primarily the majority of vessels are now diverting. Why is this important, you may be asking yourselves? Well, I've tried to put, there's two slides that try and show why this is important. This is the first slide. The chart on the left-hand side just looks at things from a headline cargo perspective versus headline fleet growth perspective. So when fleet goes higher than cargo, that's a bad sign for shipping, and you will notice there's a lot of sectors, pretty much all sectors, in the red if we just look at things from that fundamental basis. If we translate that cargo into vessel demand, and we look at the fleet in terms of the available fleet, we can see that we move a lot of sectors from the red into the green, and that gives us the strength that we saw in the market for a lot of sectors last year. Now, these inefficiencies have always been there. You know, this isn't a perfect world of shipping. If it would be, we'd probably solve the decarbonisation problem overnight. But inefficiencies have always been here, but the chart on the left just shows you how strong these inefficiencies have been over the course of the last 5 years versus where they were last decade. And I think that the chart on the right sort of really brings it home. It sort of really boils it down into sort of the simplest form. So basically what we're seeing here is the ratio between tons of cargo carried in dry bulk versus the demand for shipping of dry bulk. So what it's basically saying is if you've got one deadweight on a dry bulk ship at the start of this century, on average, that one deadweight would move 9 tons of cargo in a year. Today, that figure has gone down to 6.5 tons. So we've seen a huge drop-off in the capacity, the efficiency in the fleet due to things like diversions, due to things like port waiting time. So moving on to the other side of the fundamentals coin, the supply side, contracting has been robust during 2025, but it's not been at the levels that we saw in 2024. 2024 was the second highest ever year for contracting. This year it has come off, and it is still being primarily driven by the container ship markets, though we have seen a shift from large container ships. We're still seeing large container ships, but we've seen a few more small container ships added to the mix. Where have those contracts been placed? Well, China has dominated shipbuilding and receiving orders for new vessels over the course of the last few years. We did think in Q2 that perhaps we were starting to see a change with the USTR, with the Ships for America's Acts being launched in Q2. And as you can see, there is a sort of a blip where China doesn't take quite as many contracts in Q2. But we think it was a blip, and basically, as we can see in Q3, it's gone back to business as normal. Primarily, if you want to order a ship, then your chances are you're going to order it in China. With all those orders, it does mean that the shipyards are very full. As we can see on the chart on the left, realistically, if you were going to place an order for a ship today, especially if it's a large ship, your best bet is you're going to squeeze it in 2028. You're really not going to get it in 2027 unless you've got a good relationship with the shipyard, unless you want to pay a premium. And orders, you know, they're still following this pattern that we've seen over the last few years. Is it ordering for dual fuel vessels? If you're ordering container ships, if you're ordering car carriers, you'll go dual fuel. If you're ordering tankers, if you're going bulkers, typically you'll go for conventional fuel. And we do think that will change within time, but not for the next couple of years. So the order book is today very large in absolute numbers, as we can see on the chart on the left-hand side. I think it's important to put the order book in context with the size of the fleet. So we can see that, you know, as I say, 2024 was the second record ordering year ever, only eclipsed by, I think it was 2027. But we can see the order book in that period, 27, 28, represented 50% of the fleet. Today it's just 20%, just because the fleet has got so much bigger. However, we do see, we think, some over-ordering if we compare the order book with the replacement tonnage demand, i.e. those vessels over 15 years old on the chart on the right. We've highlighted those where in red and in yellow where perhaps there are concerns, i.e. the order book is bigger than the aging fleet. And as you can see, it really is the large container ships, it's LNG, and it's the large gas carriers, the LPG, and that sort of 80 to 150,000 deadweight bulkers where the order book is very, very large in relation to what the current fleet looks like. Shipbuilding capacity is something that has become a hot topic this year. I think what's coming out of the US has grabbed a lot of the headlines. Shipbuilding has now been seen once more as a strategic industry, but it's not just the US. This year we've heard things coming out of India, Japan, Philippines, even Brazil, that they want to sort of re-energize, reinvest in their shipbuilding capacity and help it grow as a strategic industry for the domestic economies and potentially for sort of naval purposes as well. And we can see our forecast of a development of shipyard capacity and how the other nations, the orange on the chart, really start taking market share over the course of the next sort of 10 or 15 years. So finally, sort of wrapping it all up and trying to bring it all together, looking at where we stand from an earnings and values perspective. This is our sort of market balances chart. This is where we bring together everything on the demand side and the supply side. And what we've done here is we've inverted the supply because it's a bit easier on the eye to try and then work out what it means for market balances. So where we see big yellow bars, that means we're going to see a lot of supply being delivered, and then that helps explain why we expect to see some softening in the utilization rate, in the employment rate for the main three sectors as we move forward over the next few years. What that means, as we see a softening in utilization rate, we do expect to see a softening in one-year TC rate, as we can see on the chart on the left. Generally, we'll see a softening. We're not seeing a collapse, even for that container ship, although it does look quite, on this scale, it does look quite stark in terms of the fall-off. Those levels are still relatively healthy when we compare it to where we saw earnings at the start of this year. And if we compare the earnings forecasts for the next couple of years versus the historical averages on the chart on the right, again, for many sectors, earnings will remain at or significantly above historical averages. Something that has come into the mix, of course, or will potentially come into the mix, is the IMO midterm measures. This has made anyone trying to even look at today's earnings a headache, let alone trying to forecast what's going to go on over the course of the next 10 years or so. We've just done a lot of analysis on what the IMO midterm measures will actually mean, given the various fuel choices available and the penalties and the rewards that are associated with those fuel choices and the fuel prices themselves. And this is our current situation and the differentials that we're seeing with our modelling of how those different asset classes will look depending on what fuels you're burning based on IMO midterm measures. New building prices have begun to soften. We always said that they would do once delivery started outpacing contracting, which they have done this year. We expect to see that softening continue for the next 2 or 3 years as we see less vessels being ordered at the yards than being delivered. The only thing that the yards have got in their armament is to reduce pricing to try and attract more orders. So we expect to see that pan out over the course of the next 2 or 3 years, as we can see on the charts on screen. Again, the new building price we can see on the right doesn't come back down to the levels that we saw at the start of this decade. So it is a softening rather than a collapse. Second-hand values, I would say, remain stubbornly high and sticky. As I say, LNG has seen record lows in LNG this year, but you can see on the bottom right-hand chart that the LNG asset value hasn't sunk even below the average over the last 5 years, let alone below the sort of the grey box, which is the envelope of the lowest that we've seen in the last 5 years. Dry bulk, it's been okay. It hasn't been amazing, but again, the dry bulk second-hand values have remained relatively high. And if you cast your mind back to that one of those first slides, the break-even versus one-year TC rate, I said something has to give, and I think it will have to be asset values in the dry bulk class over the course of the next 12 to 18 months to make these earnings and the economics more viable. Another thing that you can look at, and again, this has come out of our new Seascape system, is looking at where market values are compared to discount cash flow values. And we can see that based on our forecast for discount cash flow, our forecast for earnings, our forecast for asset values, we are seeing this disconnect at the minute between DCF and market values for the 3 main sectors, which again is a signal that we need to see some realignment between the two as we move forward. So it should be no surprise, this chart, that we expect to see asset values softening as we move forward for the next couple of years. This is just a simple box and whisker plot. The box and whiskers just show you the historical distributions of asset values. The red circle shows you where asset values are today. You can see the asset values are high in almost all cases. The green shows you where we expect them to be in 2028. So I think in all cases the green is below the red, but you will notice that the green circle remains at or above the historical median. The historical median is the horizontal bar in the middle of the box. Containers, the one that perhaps stands out. The problem with containers is that this data goes back to 1990. The world of containers is very different now than it was in 1990, so perhaps we probably need to repurpose the container data and sort of bring it back into where the container industry is more modern, where the container industry is more mature, we're seeing slightly different pricing dynamics for containers than we did in the last century. And finally, as I always like to do at a Marine Money presentation, where are the opportunities from a pure investment standpoint? So the investment exercise that I've run through this time is, I've said, well, we're going to go out and buy a 10-year-old, and we're going to buy it today, or actually we're going to sit on our hands and wait 12 months and do something out with all of that cash for 12 months and invest it in 12 months' time, and where are the best IRR returns. And fundamentally, you can see that actually we're probably saying it's probably best, and as investors, I'm sure no one likes to hear this, but it's probably best sitting on your hands for 12 months and investing in 12 months' time. than it is today. But there are still positive returns available across most of shipping, even if you did place an investment today. And of course, probably locking in some cargo, locking in some high time charter rates is probably going to be your best bet. So that's everything I had to say as usual. Hopefully there was something there for everyone. Appreciate a lot of information, a lot of data, a lot of charts. We'll be around today if anyone has any questions following. Thank you all for listening.